Early retirement is not a finish line. It's a system you have to run for decades. This 2026 checklist helps you test whether the system is strong enough before you leave your paycheck behind. Start with the reality check. What does your life cost per year, after taxes, including housing, healthcare, travel, and the boring expenses that never show up in retirement fantasies? A real number creates clarity, and clarity drives better decisions. Next, separate expenses into two buckets: must-pay costs and nice-to-have costs. Early retirement gets easier when must-pay costs are stable and predictable, and when nice-to-have costs can flex during tough market years. Now build your income map. Early retirement usually needs a bridge plan that covers the gap before traditional retirement benefits begin, and that bridge is where most plans break if it's not designed upfront. The most common bridge is a withdrawal strategy that respects age rules. Many people don't realize that tapping retirement accounts early can trigger a 10% penalty unless an exception applies, so the access plan matters as much as the investment plan. One access tool some early retirees use is the Rule of 55, which can allow penalty-free access to the 401k from the employer you separate from in or after the year you turn 55, under specific conditions. The timing and the account location are part of what makes this rule very specific. Another access path is 72T, also called substantially equal periodic payments, which can allow early withdrawals without the 10% penalty if the payment schedule follows IRS rules and continues long enough. This tool is powerful, and it is also rigid once started, which is why it is treated like a long-term commitment. Now shift to the biggest hidden pillar of early retirement: healthcare. Before Medicare starts at 65, your plan has to cover insurance, deductibles, and the risk of higher than expected medical spending, which can turn a strong plan into a fragile plan. Your healthcare strategy usually falls into a few lanes: employer retiree coverage if available, COBRA as a short bridge, ACA marketplace coverage, or a spouse's plan. Each option changes your monthly cost, and some options change how important income planning becomes. Income planning matters because healthcare and taxes interact. When income spikes from withdrawals, Roth conversions, or capital gains, it can raise costs today, and it can also create future Medicare surprises through IRMAA once you enroll, due to the 2-year look-back rule. The IRMAA point is simple. Medicare surcharges are based on past tax returns, so a big income year at the wrong time can affect premiums later. This is a planning issue, not a tax filing issue, and it shows up often after people leave work. Now stress test your cash flow. A practical early retirement test is to run your plan through 3 scenarios: normal markets, a 2-year market drawdown early in retirement, and a higher than expected healthcare year, because those are common failure points. Next, audit your portfolio for simplicity and purpose. Early retirement portfolios usually need a spending runway concept, meaning you know which dollars fund the next 12 to 24 months, which dollars fund the next 3 to 5 years, and which dollars are truly long-term. Debt strategy is another checkpoint. Some early retirees prefer entering retirement with minimal fixed payments, and others keep low-rate debt, but maintain a strong liquidity buffer, because early retirement is sensitive to forced selling when cash is tight. Housing becomes a strategic decision, not just a lifestyle choice. A paid-off home can reduce monthly stress, while a high-cost home can turn retirement into a monthly cash flow fight, and that difference often decides whether early retirement stays comfortable. Taxes still matter even after leaving work. The checklist item is not avoid taxes, it's avoid surprise taxes, because unmanaged income spikes can create higher tax brackets, higher Medicare costs later, and less flexibility when markets are down. Now add the lifestyle pillar that many people ignore: time structure. Early retirement is easier when you already know what your weeks look like, how you stay social, and how you maintain purpose, because boredom and isolation create expensive decisions. A practical lifestyle readiness test is to plan a prototype month of retirement. The goal is to see whether your daily routine is real and satisfying, or whether it depends on endless travel or constant spending to feel meaningful. Finally, run the exit plan like a checklist, not a leap. The strongest early retirements usually have a written plan for income sources, withdrawal order, healthcare coverage, and a decision rule for what changes if the market drops, because that removes emotion from the first hard year. Early retirement in 2026 is truly readiness across money, healthcare, and lifestyle, and the plan becomes clearer when each pillar is mapped in a simple system.